Hello, my name is Gopala Vasudevan. Today we'll talk about Chapter 4, and Chapter 4 deals with exchange rate determination. So what are some of the things we want to talk about today? We'll talk about how you can measure exchange rate changes or exchange rate movements. We will talk about what are the factors that determine the equilibrium exchange rate. Okay. We'll also talk about the movement in cross exchange rates. Okay, so these are the main things we want to talk about here. So if you look at the graph I have here, that shows you how the exchange rate moves. And what we have is, we have the US dollar versus the euro. Now, how does it look like? So if you look at the pattern of exchange rate movements, perhaps if you remember taking class in corporate finance where you looked at the movement of the stock market, you might find something very similar. And normally when you look at the way the exchange rate move, or if you look at the way the stock prices move, these are referred to as a random walk. So a random walk basically means that it's very difficult to determine the pattern. It's almost like somebody who's drunk. They're not sure where they're going. They might be walking all over the place. Now here, what we have is, we have, towards the end of the class, we want to talk about George Soros. And basically what he was doing was, he was taking a bet that the British pound would decline against the Deutschmark. So that was a long time back in the 1990s. And based upon his bet, he made a substantial amount of money. Okay, so we'll talk more about that very soon. Okay, and before that, let's talk about the basic facts in this chapter. So what about exchange rate movements? So when you talk about exchange rate movements, we can talk about the percentage change in the foreign currency value. So what is the percentage change in the foreign currency value? That would be the price yesterday, so that is ST minus 1. Okay, S is today's price, and ST minus 1 is the previous day's price, or that could be the previous year and today and so on. So if you want to look at the percentage in the price, that is the price today or the exchange rate today minus the exchange rate in the last period divided by the exchange rate in the last period. Okay, so when you look at the exchange rates, we can have depreciation and we can have appreciation. So what is depreciation? The depreciation is a decline in a currency's value. So basically there we are saying that the value of the currency is going down over time, while appreciation is the increase in a currency's value. So there we are saying that it's going to improve over time. Okay. Now what about the exchange rate equilibrium? So basically here what we are saying is that just like anything else, the exchange rate is determined by the demand and supply of the currency. And in this case, demand for a currency increases when the value of the currency decreases, leading to a downward sloping demand schedule. So basically here, we are saying that as the prices go down, more and more people want to buy the currency. What about the supply? Supply of a currency increases when the value of the currency increases, leading to an upward sloping supply schedule. So there, as there is more demand for the currency, and as the price goes up, we can expect the supply also to go up. Okay? And in liquid spot markets, exchange rates are not highly sensitive to large currency transactions. So basically we are saying that a big trade, such as somebody selling 100 million pounds or $100 million, should not have a big impact on the exchange rate when the volume of the currency is very large and the markets are very liquid. So here we have the demand schedule for British pounds, and what we see here is that as the price goes down, there's going to be more demand. Okay, then we have the supply schedule, which basically tells you that as the price goes up, more and more people want to sell the British pound. Okay, and the intersection of the demand and the supply, that is the equilibrium point. So basically that is what is saying, that you have buyers and you have sellers. They are basically agreeing on a price, and that would be the intersection of the demand curve and the supply curve. So for us, that is 1.55. Now we want to talk about the factors that influence exchange rates. So what are the factors that influence exchange rates? So the factors we have here are, we are saying that the percentage change in the spot rate. So we are talking about the change in the price of the British pound or the change in the price of the euro. That depends upon certain variables. And what are the variables? The first is the delta inflation, the change in the differential between US inflation and the foreign country's inflation. The second is the change in the interest rate, and that is a change in the differential between the US interest rate and the foreign country's interest rate. So that is the delta interest rate, okay? And delta income, that is a change in the differential between the US income level and the foreign country's income level. Then delta GC, the change in government controls. And the last one is delta EXP, that is the change in the expectations. So I think one thing you have to realize is that all the variables are looking at the difference between the two countries. So inflation in the US minus inflation in the UK, interest rate in the US minus the interest rate in the UK, the income in the US minus the income in the foreign country, that is the UK, and then we have change in government controls and change in expectations. And when you look at delta, delta is the change in this variable. So we are taking the difference and we are looking at the changes in this difference. So let's talk about each of these variables. So the first one is relative inflation. So that is the inflation in the US to the inflation in the UK. So increase in US inflation leads to increase in US demand for foreign goods and increase in US demand for foreign currency and an increase in the exchange rate for the foreign currency. So basically here what we are saying is that as the inflation in the US goes up, then prices of the things are going up in the US, which basically means that because labor costs are going up and so on, people might want to import more stuff from abroad because it's cheaper. And when you import more stuff from abroad, what's going to happen is that you have to sell US dollars and you have to buy the foreign currency. So in that case, we can expect a decline in the value of the currency. So the US dollar can go down in value if the inflation in the US is higher than the inflation in, let's say, UK. The next one is relative interest rates. So if you have taken economics and even perhaps the corporate finance course you took, basically what we say is that normally when you look at the interest rates, the quoted interest rates are the nominal interest rate. And what is the nominal interest rate? The nominal interest rate is the real interest rate plus the inflation rate. So these are the two factors. We have the real rate and the inflation rate. So what is the real rate? The real rate is the nominal interest rate minus the inflation. So what we are really saying here is that whenever we talk about the relative interest rates, we are talking about the real rates, okay? And in this case, an increase in US rates leads to increase in demand for US deposits and a decrease in demand for foreign deposits, leading to an increase in demand for dollars and an increased exchange rate for the dollar. So what we are saying is that whenever the real interest rates are higher in the US, what can happen is that investors from other countries, they want to buy the US bonds simply because they get more money, they're getting a higher interest rate in real terms. Okay, so because of that, we can expect the value of the US dollar to appreciate. Okay. Now the next one is the relative income levels. So it's a little bit counterintuitive, and what we are saying is that as the economy gets better, as people have more money, chances are we want to buy more goods, and there's a very high chance we will be importing more from abroad. And in that case, we can expect the US dollar to decline in value. So that is perhaps a little bit counterintuitive. As the economy gets better, we also can expect the currency to depreciate. Now we want to talk about government controls. So what are some examples of government controls? One is imposing foreign exchange barriers. So here we are saying that the government might restrict the free movement of the currency. They might not allow people from abroad to buy the US dollars, or perhaps, people in the US to buy the foreign currency. The second is imposing foreign trade barriers. So these are restrictions on trading. So some examples would be a higher tax on imports, some other taxes and so on, that might make it more expensive to import from outside. Intervening in foreign exchange markets. So when you talk about George Soros and the British pound, basically what we will see is that sometimes in the case of the UK, what happened was they did not want the British pound to decline in value, and to prevent that, what they did was whenever people sold the British pound, the British government went and bought the British pound. And the reason why they did that was because they wanted to keep the value of the British pound high. They did not want that to go down in value. On the other hand, if you look at a country like Japan, they want the opposite to happen. They want the Japanese yen to decline in value. And sometimes when the Japanese yen appreciates, what they do is that the Japanese government sells the Japanese yen and buys the US dollar. So that way they are hoping that the US dollar will appreciate in value. Now, government can also affect macro variables such as inflation, interest rates, and income level. And the reason is that they can control interest rates, okay? They might be able to control inflation and so on. So these are some of the examples of the government controls. And the last one is expectations. So here, if investors expect interest rates in one country to rise, they may invest in that country, leading to a rise in the demand for foreign currency and an increase in the exchange rate for foreign currency. So impact of signals on currency speculation. Speculators may overreact to signals causing currency to be temporarily overvalued or undervalued. So basically here what we are saying is that sometimes one factor that affects exchange rates is the belief of investors. So for example, if people expect the British pound to appreciate, and if everybody buys a British pound, the British pound will appreciate by itself. So there, sometimes that is referred to as self-fulfilling expectations. So you have a certain belief, based upon that belief you are acting, and because of that, the currency is going to appreciate. Now, what about reality? In reality, what you might see is that the way the exchange rates are moving can be due to more than one factor. So inflation, interest rates can come together, and that is the problem that you might face in practice. You're not sure which one of these are more important. And the next one is influence of factors across multiple currency markets. So common for European currencies to move in the same direction against the dollar. So what we are saying is that when the dollar appreciates, it's going to appreciate against most of the major currencies. It's not going to appreciate against a few. Chances are that would be an overall effect, or that could be a global effect. Now we want to talk about a few examples. If Asian countries experience a decline in economic growth and experience a decline in inflation and interest rates, how will their currency values be affected? So we are talking about two factors that affect exchange rates. One is inflation, and what we said was because of higher inflation, you can expect the currency to go down. And the second is interest rates, and what we said was as interest rates go up, we can expect the currency to appreciate. Now in this case, what we have is a decline in inflation. So as the inflation declines, the currency should appreciate, and as interest rates go down, the currency should depreciate. So we have two effects, and they will be in opposite directions. Okay, and what do we have here? A relative decline in Asian economic growth will reduce Asian demand for US products, which places upward pressure on Asian currencies. However, given the change in interest rates, Asian currencies corporations may now invest in the US. Thus, a decline in Asian interest rates will place downward pressure on the value of the Asian currencies. So the overall impact depends on the magnitude of the forces. So we said that there are two effects. One is interest rates. As interest rates go down, the currency value should decline. The other is inflation. As inflation goes down, the currency value should appreciate. Now the next one, factors affecting exchange rates. Mexico tends to have much higher inflation than the US, and also much higher interest rates than the US. Inflation and interest rates are much more volatile in Mexico than in industrialized countries. the value of the Mexican peso is typically more volatile than the currencies of industrialized countries. From a US perspective, it is typically depreciated from one year to the next, but the degree of depreciation has varied substantially. Identify the most obvious economic reason for the persistent depreciation of the peso. So what we talked about was inflation is one factor, interest rates is another factor, and both of them are here. And perhaps the reason why the Mexican peso is so volatile is because of the higher inflation. So the higher inflation in Mexico relative to the US will bring down the value of the peso relative to the US dollar. Okay? Now this basically summarizes how the movements in cross exchange rates can affect the values of the currencies. So if currencies A and B move in the same direction, there is no change in the cross exchange rate. So both, let's say, the euro and let's say the yen are going down in the same direction as the US versus the US dollar, we might find that there is no difference between the cross exchange rate. So we are talking about the euro to the Japanese yen. Now, when currency A appreciates against the dollar by a greater degree than currency B, then currency A appreciates against B. So here we are saying that if the euro increases in value against the dollar by a bigger amount than the appreciation of the yen, we can find that the euro also will appreciate against the yen. The third one, when currency A appreciates against the dollar while currency B is unchanged, currency appreciates against currency B by the same degree as it appreciates against the dollar. Okay, so basically here we are saying that the euro has increased in value while the Japanese yen has not increased in value. So in this case, the euro should appreciate against the Japanese yen. Okay. So what we have here summarizes some of the things we talked about so far. So we have what are the factors that affect the exchange rates. So the first one is inflation, and what we said was as inflation goes up, the US demand for foreign goods will go up, and in this case US demand for the foreign currency would go up, and because of that we will find that the US dollar will depreciate. Now what happens in the income differential, as people have more money in the US relative to, let's say, China or Japan, chances are we're going to import more from abroad because we have more money to spend, we buy more stuff, and again that can decrease the value of the US dollar. The next one is the government trade restrictions. So if there are the restrictions placed by the US against importing from Japan, it means that there is going to be less demand for the Japanese yen. Okay, and that is going to be bad for the Japanese currency. Now, what are the financial factors? The financial factors are the interest rate differential and the capital flow restrictions. And in this case, whenever the interest rates in the US, we are talking about the real rates, are higher than the interest rates, let's say, in Japan, chances are people in Japan want to invest in the US. And because of that, the dollar should appreciate. And the last one is capital flow restriction. So here, if the Japanese government says that you cannot convert the Japanese yen into US dollars, it means that there's going to be less demand for the US dollar, and that can put downward pressure on the US dollar. So these are, I think, the main variables we talked about in this chapter. Okay. Now what we have is, we just want to look at some of the examples of what companies might do when they expect the currency to appreciate and when they expect the currency to depreciate. So what we have is bank speculation based on expected appreciation, bank speculation based on expected depreciation, and speculation by individuals. Okay. So I think this is a important question. You definitely want to make sure you're comfortable with this. It's not very difficult, but you might get something like this in the exam. Okay. So here, Blue Diamond Bank expects that the Mexican peso will depreciate against the dollar from the spot rate of 0.15 to 0.14 in 10 days. The following interbank lending and borrowing rates exist. US dollar, the lending rate is 8%, the borrowing rate is 8.3. Mexican peso, the lending rate is 8.5, the borrowing rate is 8.7. Assume that Blue Diamond Bank has a borrowing capacity of either 10 million dollars or 70 million pesos. how can Blue Diamond Bank attempt to capitalize on the expectations without using deposited funds? Estimate the profits that could be generated from this strategy. So I think whenever you get a question like this, it's not very hard, but I think the first thing you want to remember is that in this case, what you're trying to do is you are trying to make some money, assuming that the Mexican peso will depreciate. So what I have in red is the depreciation. And the strategy here is that you always want to borrow in the currency that is expected to depreciate, and then convert it into here US dollars. Okay, so if you do that, what we believe is that you get the interest rates in the US, and the lending rate is 8%. So if you have $100, you get 108. And at the end, when you convert it back into US dollars, you will have even more money. So that is the benefit. Okay. So here, you expect the Mexican peso to depreciate. So that's why you want to borrow the Mexican peso. And it says that you can borrow up to 70 million. Convert the Mexican pesos to US dollars. You end up with 10.5 million US dollars. Lend the dollars to the interbank market at 8%. So the future value you have is the $10 million you start with, you end up with 10,523,333. So one thing you want to make sure is that we are only investing for 10 days. So you can either take it as given here, or you can take 1.08 raised to 10 by 360 times 1.08. Okay, so that way you get the right answer. Okay, and if you repay the loan, basically it's going to cost you $70,169,167, and the cost is going to be $9,823, $9,823,683. Your profit is going to be $699,650. So the numbers look very good, but chances are, in reality, you may never be able to predict perfectly what's going to happen, and it looks like a big change for such a short time period. Okay, but if you're lucky enough, you can do this. That's going to be very profitable. So what are the keys here? You always want to borrow the currency that is depreciating, and here that is the Mexican peso. Convert, invest in the US, because the US dollar is going to appreciate. At the end, just convert it back into repay the loan, and you will have quite a bit of money left. Now the next one, speculation on expected exchange rates. Koenig Company expects that the pound will depreciate from 170 to 168 in 1 year. It has no money to invest, but it could borrow the money to invest. It has been approved by a bank to borrow either $1 million or 1 million pounds. It can borrow dollars at 6% or pounds at 5% for 1 year. It can invest in a risk-free deposit at 5% for 1 year, or a risk-free British deposit at 4% for 1 year. Determine the expected profit or loss if Koenig pursues a strategy to capitalize on the expected depreciation of the pound. Okay, so what do we do here? If you go back to the question, it says that the pound will depreciate from 170 to 168. So what that tells you is that you want to borrow the British pound and invest in the US. Okay. So initial amount borrowed is £1 million. If you convert it into US dollars, you get 1.7. If you deposit it at 5%, you end up with 1,785,000. And the amount you borrowed in British pounds, the cost is going to be £1,050,000, and the cost, if you want to pay with dollars, is $1,764,000. So your profit is going to be $21,000. Okay. So we looked at two examples. So chances are, you might get something like this in the exam. This is not a very hard question, but the key is that where people make the mistake is that they might choose the wrong currency. So which one do you borrow? You want to borrow the currency that is expected to depreciate. Okay. Now, the last thing I want to talk about is, I want to talk about a big bet placed by George Soros. So if you go online and check, people talk about the biggest trades ever, and this trade by George Soros is among the very best. So people rank it as perhaps #1 or #2 of all the trades made in financial history. Okay. So here, he's around, I think, 80 years now, and this was a speech he gave at the World Economic Forum. So that was in Las Vegas some time back, and it was hosted by Bill Clinton. Okay. So what is the bet he did? So this is quite some time back. We are talking about the European monetary system that was established in order to stabilize exchange rates, reduce inflation, and prepare for monetary integration. So basically, the European countries wanted to come together, and this was before the euro, but they still had some plans, and they were basically looking to stabilize the exchange rates so that they can trade within themselves and so on. So what they did was they established the exchange rate mechanism. One of the European monetary system's main component gave each participatory currency a central exchange rate against a basket of currencies, the European currency unit. Okay, so this is what they want to do, and participants were then required to maintain their exchange rates within a 2.25% fluctuation band above or below each bilateral central rate. Okay, so here the ERM was an adjustable peg system, and 9 realignments would occur between 1979 and 1985. While the UK was not one of the original members, it would eventually join in 1990 at a rate of 2.95 Deutschmarks to the pound, and with a fluctuation band of plus or minus 6%. So we already had some countries as part of the European system, and the UK came after some time. And at the time when they joined, the exchange rate of the British pound versus the Deutschmark, so that is the currency of Germany, was 2.95 Deutschmarks to the pound, and that could move in either direction, plus or minus 6%. So till mid-1992, the ERM appeared to be a success, as a disciplinary effect had reduced inflation throughout Europe under the leadership of the German bank. So basically things were quite successful, and overall inflation was in check all over Europe. But just like we see in the case of the euro now, that stability wouldn't last, as international investors started worrying that the exchange rate values of several currencies within the ERM were inappropriate. And the biggest problem took place after East Germany and West Germany came together. And the problem here was things were not that great in East Germany, and because of that, West Germany had to make significant investments, and to make those investments, they had to print a lot of money. And when you print money, it leads to higher inflation, and in this case, the German central bank, to contain the inflation, they decided to increase the interest rates. Now, when you increase the interest rates, what happens is the value of your currency will go up. So the German mark would be appreciating against the other currencies, and because of this, it forced other central banks to raise their interest rates as well, so as to maintain the peg currency exchange rates. So realizing that the UK's weak economy and high unemployment rate would not permit the British government to maintain this policy for long, George Soros stepped into action. So basically at the time, the UK was one of the weaker economies. And when your economy is weak, you just cannot afford to increase interest rates. And the reason being that if you increase the interest rates, companies are going to borrow less and invest less. That because of that, the economy would go down even further, and unemployment rates would decline. So that was, would increase even more, and that is not a good strategy. So George Soros understood that for a weak economy like the UK, they were not able to afford to do that. Okay? So what is the bet he took? Basically, he established short positions in pounds and long positions in marks by borrowing pounds and investing in mark-denominated assets. So just like we talked about for the banks, the two examples we did, this is pretty much what he's doing. He's borrowing in the currency that is expected to depreciate and investing in the currency, which is the British mark, that is expected to appreciate. And to increase his investments, he also made great use of options and futures. So the benefit of options and futures is you only have to put down 5% or 10%. You can control a much larger investment. So you have a lot of leverage. In all, his positions accounted for a gargantuan 10 billion. Soros was not the only choice. Many other investors soon followed suit. So basically what we find here is that his total investment was, he was long on the mark and short on the British pound, almost $10 billion. Okay? And when other investors saw this, like hedge funds and so on, they basically started copying George Soros, and because everybody was selling pounds and buying the mark, just like we talked about, there was an increase in the supply of the British pound, which put downward pressure on the currency. Now, when the Bank of England saw that, initially they tried to defend themselves, and like we said before, we are talking about government intervention. So they bought 15 billion pounds with their reserves. Okay, so they started buying the British pound to keep the value of the British pound up. But as we said, usually that's very difficult to sustain. And the reason being that if the British government is willing to buy the pound at a higher price, more and more people will be selling the British pound because they're getting a good price. So the pound was trading dangerously close to the lower levels of the fixed band on September 1992, a day that would later be known as Black Wednesday. The bank announced a 2% rise in interest rates in an attempt to boost the pound's appeal. So what we are saying is that the UK government realized that buying the British pound is not going to keep the value up. So the next strategy available for the government is to raise the interest rates. So they jacked it up by 2%, which is quite unimaginable. So not many people will do something like this. And a few hours later, it promised to raise interest rates again to 15%, but international investors such as Soros could not be swayed, knowing that huge profits were right around the corner. So basically you see here that they are increasing the interest rates from 10 to 12 and then to 15%. But people realize that this is unsustainable. Okay, and at the end of the day, what happened was that the government of Britain gave up. The Chancellor Norman Lamont announced that Britain would leave the ERM and rates would return to the initial level of 10%. The Black Wednesday marked the beginning of a steep depreciation in the pound's effective value. So what happened because of this? Because of this, the British pound depreciated 15% against the German mark and 25% against the dollar. So that was a big decline against both these currencies. And Soros' profit was close to $1 billion. So he made $1 billion, and in the 1990s, that is a huge sum of money. So $1 billion is definitely worth a lot more than what it is today. And right now, is there any story that is comparable? So one of the stories that is comparable is in early 2015, the Swiss government, they removed some restrictions about the value of the Swiss franc versus the euro. And because of that, I think almost overnight, the Swiss franc increased by 20%. Now, because the Swiss franc increased by 20%, there were some winners and some losers. Citicorp, I think, lost $400 million. Some of the JP Morgan, I believe, made $500 billion. Sorry, $500 million. So again, you know, these are some examples of what can happen to currencies and how it can affect the exchange rates and how sometimes people bet and make a huge amount in the currency market. And as you said before, the trade by Soros is one of the biggest trades ever as far as the markets, financial markets are